Hello and welcome to the Scan the Market update with myself, David Madden. I work as a market analyst for Equity Capital in London, and Equity Capital is a part of the overall equity group, which also includes FX Pesa in Kenya. First and foremost, before we actually get into the actual update, the actual coverage of the markets, what I want to quickly do is just basically do a quick introduction to the risk warnings, which keep our compliance department happy. Bear with me one moment, please. What you should be able to see in front of you now is the FX Pesa logo up here in the top left, and also risk warning here saying trading in margin products carries a high risk. And essentially, the entire point of this kind of brief risk warning in advance of the actual webinar itself is basically to say anything that I cover in this webinar is purely my own thoughts, views, and opinions. It's not trading advice, it's not trading ideas, and it's certainly not the views of FX Pesa or Equity Capital or the equity group as a whole. So, for those of you who have tuned into a few of my events before, the basic rundown is I run through a handful of the major markets, be it a few big currency pairs, a few big indices, a few big commodities. I'll talk about the major fundamental news of the day, what's driving the markets, and I'll also analyze the markets from a technical analysis base as well. And then what I'll do is I'll have a few markets that I run through. If there are any questions at all you have for me while I'm explaining something, be it the Maxi Indicator or support and resistance or whatever it is, feel free to just stop me right there and say, "Oh, David, I don't understand that." Feel free to just ask a question. Also, while I'm running through certain markets, feel free to just basically say, would you mind taking a look at silver, or would you mind taking a look at dollar CAD, or whatever it is? I'll happily take a look at any markets you want me to suggest. So before I'll just wrap things up now in terms of the risk warning. I'll look to get things going in terms of the actual event itself. First currency pair that I'm looking at here on the screen is the Aud USD. Just to let you know, I'm looking at a 4-hour chart. I'm looking at the charts I'm looking at are a 4-hour time frame. I have 3 moving averages on the screen. This one is a 20-period moving average, a 50-period moving average, and a 100-period moving average. So if you're going to wonder what these lines are on the screen, they are moving averages. Hello for all of those who've just joined. The good news is you're right on time for the first chart of the day. What we're looking at here is the AUD versus the US dollar. There's a couple of things going on. The big story in the financial markets for the past 24 hours, starting with today's news, we had weaker than expected PPI in the US. PPI, Producer Price Index, essentially a measure of the cost of goods and materials and whatnot that factories incur. And the PPI, Producer Price Index in the US, came in at 9.8%. It was a large drop-off from the 11.3% posted in the last report, and it came in below expectations. Economists were expecting a reading of 10.4. So it was a fairly large drop-off, number one, and it was well below expectations. So with that, as a reaction, we saw a sell-off in the US dollar. Why is this? Well, inflationary pressure and CPI, Consumer Price Index, has been a big story in the financial markets recently. It's the main driver why central banks like the Federal Reserve in the US are hiking interest rates. So when the PPI rate declined, that gave traders that prompted some traders to think to themselves, if PPI is falling, chances are CPI, Consumer Price Index, will fall as well down the line, and that might lead to the Federal Reserve taking a less hawkish stance in relation to hiking interest rates. Keep in mind, the Federal Reserve hiked interest rates by 75 basis points in June and in July. And following last Friday's very strong US non-farm payrolls report, there was speculation there might be another 75 basis point rate hike from the Federal Reserve next month. But as I mentioned, today's headline PPI numbers declined and they fell but by more than expected. Keep in mind, only yesterday, in terms of CPI, Consumer Price Index, that dropped in the US as well. It fell to 8.5% from 9.1. It was a fairly large fall. It came in below expectations. So overall, the past 24 hours, things have been quite depressing for the US dollar. So weakness in the US dollar. And on top of that, because the US dollar has been weak, that's gave assistance to industrial metals such as copper. And Australia is a major exporter of industrial metals like copper. So it really has been a double whammy. The strong Australian dollar on its own, combined with the weak American dollar, the weak US dollar, led to an uprise AUD USD. What's going on here? The currency pair actually hit its highest level in 2 months. It was at the highest level since early June. It's been in a strong upward trend here. Looking at the Maxi Indicator, which is essentially a measure of momentum, whether essentially who's in control, is the power with the buyers or is the power with the sellers. You can see here on the Maxi Indicator that momentum is in positive territory, indicating that the buyers are in control, the bulls are in control. While the currency pair continues to hold above these three simple moving averages, it's likely the more medium-term upward trend will continue. A further rally from here could see a target 0.7137. And a break beyond that could see a target 0.7193. If we take a look at the RSI, the relative strength index, it's essentially a measure of kind of almost like think of the RSI as kind of like an elastic band. You know, how far you can actually kind of stretch it out or not. And when markets have good violent moves in one way or the other, sometimes the markets can be overstretched. Essentially, the market kind of gets overcooked, as it were, the move, and then sometimes you do see a move in the opposite, a retracement. So you can see here in the RSI, it's moved into overbought territory. That could be a kind of a flash warning sign to say this very impressive rally that's happened here, that's overcooked, it's overstretched. It could be, no guarantees, but the fact that it's in overbought territory could be an early warning sign. The sharp upward move price might be overstretched. Should that be the case, and if you were to see a decline in the price from here, fill the target this zone here at 0.7039, and a break below that could see us back down towards 0.6965. Speaking of the topic of a weak US dollar, let's also take a look at Eurodollar, one of the more prominent currency pairs. Eurodollar has also enjoyed a very, very positive run, mostly down to the fact we've seen weakness in the US dollar across the board. I mentioned one moment ago how the Australian dollar, US dollar hit a 2-month high. Well, yesterday we saw a 1-month high in euro dollar. The peak of today in euro dollar got quite close to retesting yesterday's peak. It didn't quite get there, but it got close enough. So we're seeing a bit of a pattern here. Dollar's weak across the board. The euro dollar is rising. Aussie dollar is rising. We're above all three simple moving averages on euro dollar. We're quite close to the recent 1-month high that was posted yesterday. So things are looking quite bullish for euro dollar. Continue to rally from here. We could look to target up to 104 and then up towards this peak here at 1.0448, which is basically the last big peak of early July before the market fell off. And then beyond that, we could be looking up towards 1.0528. Similar situation. If you look at the price action of the RSI, it certainly is moving higher. And although there were a couple of moments it was actually already in overbought territory, if RSI continues to move higher and it does move into overbought territory, that could be the kind of early kind of warning or catalyst to say that the market, the upward move has been overstretched, overcooked. We could see a bit of a pullback. Should we move lower in euro dollar, where could we target? Well, we could head back down towards 1.0275. And a break below that could see back down toward this simple moving average here, which comes into play at 1.0277. So the weakness in the US dollar has kind of translated across other markets. So one of my kind of favorite markets to talk about, look at in general, but also talk about in these webinars is gold. I know it's a very popular market. Gold is traded in US dollars. And whenever you see a large move in one way or another for the US dollar, you typically see a decent sized move in gold. I know how it goes. I've been in the kind of retail CFD trading game for a good number of years, for well over a decade. I know some people out there just like to trade certain assets and certain markets, and that's just that, and that's fine. I would certainly agree with the idea of only trade with what you're comfortable. But if you trade gold, you must be at least aware of what's going on with the US dollar. for several months now, there's been, and I could even expand it to years, been a strong inverse relationship between gold and the US dollar. It doesn't always hold up, but more often than not, and especially recently, it does. So if anyone trades gold out there, you need to be having a look at what's going on with the US dollar and ask yourself: is the dollar rising? Is it falling? And from the current point we're at in the dollar, we've already had 2 negative days on the dollar. Are we going to see further loss of the dollar, or are we going to see a rebound of the dollar? You have to be keeping an eye on what's going on with the US dollar and keeping an eye on the perceptions about interest changes in the United States. So, kind of coincidence I talked about, it's been a pretty difficult 24 hours for the US dollar. We've seen a large sell-off in the dollar in the past couple of sessions. And lo and behold, we saw a 5-week high being printed on gold only yesterday. We got close to retesting it today. Didn't actually quite get there. We kind of shied away a bit. But nonetheless, we had a 5-week high in gold yesterday. Even though we've retreated ever so slightly from the peak, we're still above all 3 simple moving averages. We're still holding above the 20-period moving average, the 50 and the 100. So the more medium-term bullish trend is still in effect. And if this upward move continues from here, we could look to, and we were to break above yesterday's peak in at 1807. That could then pave the way for 1811 to be tested, and also for 1825. So these are the next big levels I've been looking out for to the upside for gold. Firstly, we have to take into consideration that even though the much longer term trend is higher, the much shorter term trend for gold is low. We can't really ignore the fact that today we've seen sell-off in the US dollar, but yet we haven't seen gold target and retest and break above yesterday's high. So that in itself is something which you always have to do. It's all well and good to just look at what's going on in the markets, but in a certain way you always need to question them. And today I'm questioning what's going on with gold. What am I not missing with gold? Because gold, in theory, should have broken above yesterday's peak, and it should have set a new 5-week high. Why didn't it? Is there a case of yesterday's move was overstretched? Is it a case of there isn't that much buying appetite out there? Is there a case of people, there is people out there just booking profits? Something is off in my opinion in that regards. So take a look at the more recent price action. It's been moving lower. Taking a look at the RSI, that's pointing downwards as well, indicating the price bias is to the downside. Taking a look at the Maxi Indicator, we can see that momentum is in negative territory. So for the time being, in the short term, the bears are in control, the sellers are in control. The continuation of this downward move in gold from here, where could we target? Well, we could have to target this area here at 1776, and then going below that, we could head down towards 1764. Oh, apologies, I got a question here about the Australian dollar. AUD, USD, would you consider that a possible divergence in the RSI? I'll take a look at that. Right back there. No, is the long and the short. I'm looking here once again at the Australian dollar. We can see here the currency pairs have been moving sharply higher here. We can see here that it's in overbought territory. To be fair, I'll hand you the fact that price kept on moving higher, but yet we didn't see another peak in the RSI. So there's something slightly going on, something ever so slightly going on there. I'll definitely give you that, all right. But this is where technical analysis, like anything in trading, is still itself subjective. I would look at that and go, it's a fair point. How come the RSI was more overbought here than it was when the market was up here? But at the same time, it's not a huge diversion, and there's also, in my opinion, the danger of kind of overthinking kind of more minute details. What I'll be more concerned with is if, for example, there's a clearer example of I actually am more concerned with is a Maxi Indicator. We can see here the price keeps on going higher, and in the last in the last 5 to 8 hours, we've printed a new high on the currency pair. But if you take a look at the Maxi Indicator, this histogram here, positive momentum is in decline. So the market moved higher on falling positive momentum. For me, that's a classic. That's a much more trustworthy example of divergence, and you can say to yourself, the price is going higher, but yet positive momentum is tapering off. So as far as I'm concerned, that's more kind of a standout example of divergence. But when you combine the fact the Maxi indicator is positive momentum is tapering off, it's diverging from the price, and the fact that RSI is in overbought territory, that's almost like, for some people anyways, a kind of a double the warning that the market is a change in trend is in the offing. So got a question here. If I'm executing my trades on a 5-minute time frame, what higher time frame should I use to align myself with the trend? I'll be then looking out towards more probably half an hour or a 1 hour time frame. I'll give you an example now. Hopefully I get a good example of showing something here. 1 hour trend. So this here is the 5-minute chart of gold. So the 5-minute chart of AUD USD. You can see here that it's in a fairly clear upward trend. So I'll just give you a quick kind of breakdown of very straightforward trend analysis. This is kind of quite a rough guide here. Nothing too exact, but there are kind of trends within trends. So an upward trend is defined as a series of higher highs and higher lows, and a downward trend is defined as a series of lower lows and lower highs. The market moves higher here, the higher high, it has a pullback, moves higher here. It moves higher here, it has a pullback. Where do we go from here? We've had a pullback. The lows that we set here are still comfortably above the lows that were set here, which are above these lows along here. In your head, you kind of almost like use these zigzag lines as a kind of indicator for where you think the market's going to go next. And we've already had the kind of move down here. The question is, are we going to see a corresponding another kind of final move up here? And this is what I mean about observing kind of time frames. You look at this time frame and you say to yourself, right, this here is a good example of the upward trend. Widen it out, and you can see that this is a decent upward trend within a much wider upward trend. But then if you look on the 1 hour time frame, when you look on, say for example, the 1 day time frame, jump right back out to a day, you can see that although the market's been moving aggressively higher since mid-July, the much longer term trend for gold is still lower. Keep in mind, we're now, keep saying gold, it has the A in it. Aussie dollar 0.7120 is the current price thereabouts. Keep in mind, back in April, 4 months ago, it was well north of 0.76. So even though it's rallied a lot in the last few weeks here, it went from north of 0.7600 to south of 0.6700. So the market dropped 700 pips downward move here, and it's bounced back. And if anything, I'll be looking at this and saying to myself, although on the kind of 4 hour chart, this looks like quite a bullish trend. That's it, we're at multi-week highs. I need to be thinking to myself, the market's going higher. When you zoom out to a 1 day chart, you then go, oh, right, actually, hold on. It's possible that this much longer term downward trend is actually in effect. And I could easily actually potentially run into resistance around this level here. So this is what I mean about the longer term time frame. Typically speaking, the longer the time frame, the better picture of what's actually going on. And I'll always and usually more often than not, the longer term trend wins out. Not all the time, but more often than not. So if you're looking at a 5-minute window, I would always be paying attention to what's going on in the half an hour, the hour, maybe even the 4 hour as well, just to get a feel for the kind of big picture trend. Because sometimes the smaller time frames can show you, for example, as I showed you a minute ago, a good example of a market trending higher on the 4 hour chart here. But when you look at it on a daily chart, it's actually in a still fairly clear downward trend. Does that make sense? With the question you asked about the time frames. We talked about gold that has had a good run. We'll also take a look now at the US 500, the S&P 500. That's also been on quite a bullish run recently. Why is this? Well, as I mentioned at the top of the webinar, The US CPI rate yesterday declined by a bigger fall than expected, and same with the PPI rate today. So the kind of logic is, the kind of attitude in the markets is that the Federal Reserve, the US Central Bank, might look to do another interest rate hike next month, but do a smaller size. It may or may not happen, but that's the kind of attitude in the markets. That's how traders were thinking to themselves. And if the perceptions are that next month's interest rate hike might not be as large as originally priced in, then the buyers step into the fold, which is precisely why we're seeing the strong upward trend in the US 500. It hit its highest level in a new 3-month high was set today. So that really tells you how bullish the market is. A new 3-month high has been racked up. Looking at the Maxi Indicator, we can see that momentum is clearly in positive territory, so the bulls are in control. If we continue to hold above these 3 simple moving averages, it's likely the more medium-term upward trend will continue. If we do rally from here, where could we target? Well, we could be looking up towards 42.80, and then beyond that up towards 43.00. Looking at the RSI, we can see the market has moved higher. The RSI has moved higher. It's moved into overbought territory. So this could be the kind of flash warning to say upward move has become overstretched. Will we see a pullback? Will we not see a pullback? If we do see a move to the downside in the US 500, where could we target? Well, I'll be looking up towards this simple moving average here in around kind of 41.85. You follow this moving average around the 20-period moving average, it acted nicely as support here, acted as support here, acted as support here. It didn't, on a few occasions, it acted as support and resistance along here, and then when the market broke back above it here aggressively, the market then just took off. So what I was doing there was I was observing how many times in the recent past has the 20-period moving average bit of importance, as be it as a support zone or a resistance area. And what I often say is if a metric has been of importance in the past, it makes it more likely to be of importance in the future, although there are no guarantees. And what I mean by that is some traders that come along and they'd see the rally in the US 500 and they'd see the rally in the US 500 creating a new multi-week high here. They'd notice that when it pulled back, it found support from the 20-period moving average. So for the next time it breaks higher, they spot the upward trend here. A new multi-week has been hit. Markets don't move in straight lines, so you're going to have a bit of a pullback at some point. Where is it going to pull back to? People then start placing buy orders in around the 20-period moving average. Why? Because the 20-period moving average actually has support back here. And then lo and behold, the market bounces off the 20-period moving average, moves higher again. Now, like with anything in trading, nothing works all of the time, but certain things work some of the time. So if you do see a move lower in the US 500, where can we target? 42.00, and then down toward this moving average here, which comes into play at 41.85. And if you have a decent break below that, you can then be looking down to the recent lows of 41.12. Got a couple. Someone made a comment saying they appear to be bullish on the Australian dollar, US dollar. Just to clarify, do you think the NAS will continue to rally? I take it you're referring to the Nasdaq 100. And basically, before even looking at the chart, yes, things are looking quite bullish for US stocks. So another one of the aspects of technical analysis I like to focus on, and I always mention in these webinars, is Dow Theory, named after Charles Dow, the market technician. One of the tenets of Dow Theory is that the averages must confirm each other, and what that basically means is markets that are quite similar to each other should, in theory, move in the same direction, probably by the same amount at the same time. And if something is, and if that's not going on, then there's something up. Then there's something at play going on. So we'll take a look at the US 500. Look at the price action here. It's been in a strong upward trend, and it's going to hit a new 3-month high. How is things looking on the UT 100 now? The price action looks quite similar in that, and it's already cleared the target of 13.4. the price action is quite similar, doesn't it? Higher high, higher low, higher high, higher low, higher high, higher low, higher high. The market's in a strong upward trend. It's already hit it's already retested and cleared the recent high of 13,400. We're back up to levels last seen since May. So we're talking about, once again, 3-month highs are being set on the 3-month highs are being set on the UT100. Well, looking at the, we hit a 3-month high in the S&P 500. We had a 3-month high on the UT100. So that kind of underlines how kind of bullish the kind of upward trend is in US equities. While we continue to hold above these 3 simple moving averages on the UT100, it's like it's a more medium-term upward trend will continue. And for a further rally from here, could see a target 13,555. And then if you break beyond 13,555, kind of 14,000 will be the next big level to watch out for the UT100. Now, it is worth noting, though, it is worth noting there's a small bit of a kind of cautiousness afoot when it comes to the UT100. So we've obviously retreated from the recent peak. This red candle here denotes it's a downward candle. Markets don't move in straight lines, so you're going to have pullbacks from time to time. Looking at the Maxi Indicator, we can see momentum is firmly in positive territory, but positive momentum has dropped ever so slightly. So it suggests that although the bulls, the buyers are in control, they're not as influential as they once were. So that in itself is a bit of a worry. And finally, if you take a look at the RSI, that's edging lower as well, and it seems to have kind of peaked and looks as if it's about to kind of roll over. So if that is the case, and we do move lower from here, we could look to head back down to could see further losses. And if you do, where can we target? Well, I've been looking towards this moving average here, the 50-period moving average. You can see the general kind of not there, sort of, but not quite. It acted as support in this area here. So the market moved lower. It acted as support, kind of not perfectly, but sort of acted as support. So if I've observed this, chances are other people will be observing this as well. And this is the sort of thing where we could see buyers step into the fold in around where this moving average is, and that comes into play at 13,155. And a break below that could see us down towards the recent low, 12,943, and a break below that could see us down towards 12,800. So hope that answers your question in relation to what do you make of the Nasdaq. Got a question here. What can you say about candlesticks that are very large bodies? What do they communicate in terms of volume and volatility? It goes to show you, it tells you volatility is high. When you've got quite a big candlestick, a lot of price action went on in that area. So if you look at this candlestick here, this a good example. This is a good example now. If we look at this candlestick here, so you can see that the 2 preceding candles were red, indicating that they were negative. So the market, had peaked, then was moving, drifting lower. Then a couple of red candles, and then we have this very, very large candle here. The fact that it's very large tells you it's volatile, because that essentially measures the actual candlestick itself. The body, the candle will measure the high and the low, and the lines that are coming off it are my apologies. The body of the candlestick will measure the open and the close. The wicks on the candle, that the lines that are kind of coming off it, notice how they're very, very small. They basically denote the highs and the lows. So what you can tell is when you get a very big candle like this, there's a lot of volatility, because obviously there's been a larger price range to move around. But when I look at this candle here, I can see that essentially it opened, as they often do. It opened quite close to where the previous one closed. So if you look at this candle here, the bottom of this candle here and the bottom of this candle here are pretty much right on a par each other, because this candle here opened at this point here, kind of went all the way up, went all the way down, and it closed below the open, denoting the red candle. This candle here opened here because the previous one closed here, opened here. It drifted ever so slightly lower, and then it just shot up and just powered ahead. And notice how the candle closed quite close to the top of the actual the high of the, in this case, the 4-hour window. So it tells you that the market turned around aggressively, and there's a lot of volatility, and there's a lot of, in this case, buying power, because the market just kept on going up and up and up. It cleared these previous peaks along here, and the buying power in this 4-hour window continued on right until the very end. The market actually closed very near the end, the high of that 4-hour window. So that tells you a lot what's going on in terms of volume. It doesn't tell you anything about volume, because volume is something else. That's got to do with, actually, you need to see the underlying, what actually went through in terms of trades at that price. Excuse me. What it does tell you is it tells you that there is a lot of high volatility. And when the market has an aggressive move in one way or the other, it will be reflected. It will be as reflected as so in the candles. And then conversely, when we look at today, this big red candle here, we see the market moved higher here. It opened at this level here, which is essentially the previous close. It opened here. Most likely what happened was the market eked out another small gain, just about cleared the previous peak, and then aggressively sold off. It drove right down to the bottom end of the range here, and then it bounced back a small bit once again. And then with that, it actually closed towards the lower end in the range. So once again, big candles tell you a lot of price action went on. And big candles, in your spare time, you should look into bullish engulfings and bullish reversals. And these are the sort of price actions you normally see whenever the body of one candle completely engulfs or covers or overshadows the body of the previous candle. We said, but the individual who made the comment about, I take it they're correlated. Were you talking about when the S&P 500 and the Nasdaq 100 were trending higher? I take it that that comment was in reference to that. Good question here. Would you advise trading with the direction of high volatility? Would you mind just clarifying what you mean, please? Because would you advise trading with the direction of high volatility? So I don't quite understand that question. Are you asking, should you trade when the market is volatile, or are you suggesting you should trade with the trend? Would you mind just please clarifying the comment? I got a question here. Please analyze gold. I'll have a look at gold again very, very briefly, though. I did cover gold earlier on. But gold has been in a strong upward trend recently. We've seen weakness in the US dollar the last few sessions. If you trade gold, you got to keep an eye on what's going on with the US dollar. It's typically an inverse relationship between the two. We've seen a lot of selling in the US dollar in the past 24 hours. So it's not a real surprise. We've seen weakness in the dollar in the past 24 hours. And yesterday we saw a 5-week high being set in gold. So the two are very much, in this case, negatively correlated. An inverse relationship exists between the two. It's a bit interesting that gold didn't retest yesterday's peak. So that's, ever so slightly concerning, but nonetheless, we're well above we are well above all 3 simple moving averages. The more medium-term uptrend is still in effect. If we do hold above these 3 simple moving averages, it's likely the recent upward trend will continue to rally from here. Breaking higher from here, we could hit the target 1811. And a break beyond that, we could target 1825. Conversely, though, the market hasn't retested yesterday's peak, so that in itself is a bit of a sign. Looking at the RSI, it's edging lower, denoting the price bias is to the downside. And we can see in the Maxi Indicator that momentum is in negative territory, indicating that the bears are in control. So if you do see any losses in gold, we could look to retest this area here at 1776, and a break below that could see it down towards 1764. Now, any other markets you want me to take a look at? I'm just conscious of the fact I've been going on now for over half an hour. I'll look at another chart or two, and then I'll look to wrap things up. Thank you for clarifying that. Should you trade when the market makes a strong move in the direction of the trend? I would recommend for you to do whatever style of trading suits you. Some traders trading with the trend is what they want to do, and they'll never ever trade against the trend. Other traders out there really prefer doing what's called contra trending, whereby you trade against the difference. So, for example, in the instance here, we're looking at gold. It's all a matter of your own preference. We can see that gold was in a pretty brutal downward trend, because if you look at the price action, the lows it fell to in July, I think they're multi-month lows. The lows it fell to in July were almost a 1 year low. It was an 11-month low. So gold fell to an 11-month low only a few weeks ago. So this low here was an 11-month low. But since then, we've seen a fairly decent rebound. Higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. So in a scenario like this, you'd be observing the fact that for the last 3 or 4 weeks, gold has been trending higher. Yesterday, we had a 5-week high. That kind of indicates there's a bullish run going on here. If you're trading with that trend, buying the dip is the name of the game, as I say. And then but conversely, if you're following the trend of gold prior to the middle of July, you'll be looking at sell the rallies. Look at the price action along here. Market moves aggressively lower, has a rebound. Aggressively lower, has a rebound. Once again, a lower low. We saw a good example of the lower low, the lower high, the lower low, the lower. Okay, this high wasn't necessarily lower, but the lower low, lower high, lower low, lower high, lower low, lower high. The market, and when the market's in a downtrend, you want to be selling the rallies. It's all a matter of personal preference. Like I said, some people love trading with the trend. Other people decide that they only ever trade against the trend, or some people even trade both. You know what I mean? Some people will kind of, well, in this case, if the market's trending higher, they'll jump on the uptrend, they'll try and exit their long position, and then they might even look to take a short position and try and catch it as the market drifted a little lower, on the assumption the market will only retrace a small amount of the ground it rallied before it begins another move higher, if that makes sense. I got a question here looking at Aussie CAD. Sure, I'll take a look at Aussie CAD. This should be an interesting one, because to be fair, it's a currency pair I don't really look at very often, so this should be some fun. First things first, speaking of correlation, a few minutes ago I was looking at the AUD versus the US dollar, and Aussie dollar is in a strong upward trend. So when Aussie dollar was moving higher, the question, applying Dow Theory to the currency pairs, are we going to see a rise in Aussie CAD? And let's take a look what's going on with Aussie CAD. Lo and behold, Aussie CAD is moving higher again. How did I guess that? Well, it wasn't anything special. Dow Theory, the averages must confirm each other. Markets that are quite similar in theory should move in the same direction by the kind of same amount at the same time. The Australian dollar was very strong because of the weakness because of the strength in industrial metals like copper. Australia is a big exporter of minerals, particularly to countries like China and India. So the metals are strong, the Australian dollar tends to be strong. And I remembered that the AUD USD hit a 2-month high. So I knew full well that some of that was down to weakness in the American dollar, but also knew that partially that was due to strength in the US dollar. So if you're trading Aussie CAD, what I would do for you, what I would do if I were you, I'll be looking at how the Australian dollar is doing against other currency pairs. Is the Aussie, in this case, Aussie CAD is rising? Is the Aussie dollar rising against the euro? Is the Aussie dollar rising against the British pound? Is the Aussie dollar rising against the Japanese yen? What's going on with the Canadian dollar? How's US dollar CAD doing? How's the British pound doing versus the Canadian dollar? How's the Canadian dollar doing against the Japanese yen? And these are the sort of things I'll be looking at, because it gives you a better feel. Because if you look at Aussie CAD, you're kind of looking at it in a very kind of narrow fashion. There's a whole world impacting the Australian dollar. There's a whole world impacting the Canadian dollar. Oil being a big factor that influences the Canadian dollar. So if you're going to be trading a currency pair, break the currency pair in half, and then examine the individual legs of the currency pair. How's the Aussie doing against other currencies? How's the CAD doing against other currencies? And that'll help you kind of give you a better picture of what's going on. Aussie CAD recently, today, hit its highest level since in about 2 months. Not quite 2 months, but thereabouts. Mid-June, we're kind of thereabouts an 8-week high, a 2-month high. Aussie CAD is in a strong upward trend, higher. There's a bit of cause for concern on the RSI and the Maxi Indicator, but we've recently hit a 2-month high. We're comfortably above all 3 simple moving averages, so it seems to me the more medium-term upward trend is going to continue. If you do look to rally from here, where would I be targeting? I'd be looking up towards these peaks here, the peaks of mid-June, in at 91.30 thereabouts, and then beyond that up towards 91.50, and then 92 will be the next big level to watch out for Aussie CAD. Why am I a bit concerned? Well, yeah, we've had a bit of a pullback here, as you expect. But we can also see a bit of a move to the downside in the RSI, the Relative Strength Index. So that to me is a bit of the price buy is creeping lower. We can see a drop off in positive momentum on the Maxi Indicator. So although the buyers are firmly in control, they're not as influential as they once were. So they seem to be kind of losing a bit of ground. So in that case, we could see a bit of a move to the downside in Aussie CAD. And first and foremost, where would I be looking for a potential support area? I've been looking somewhere in around here. It's not perfect, but it's somewhere in around here. If you look at the peak that was set here, the resistance point here basically acted as a resistance, or sorry, get that. The resistance zone here in early August very basically acted again as support here only yesterday, or the last 24 hours. So with that, I'll be looking down toward this area here. That comes into play in around 90.30, 90.40 thereabouts. I'll be looking towards that area, and I'll also be looking towards the 20-period moving average, which isn't too far away from it. It's only a few pips below it, in around the kind of 0 spot 90.20 area. You can see it acted nicely as support here. I've been following it around several occasions, not all the time, but several occasions where the 20-period moving average has acted as support. So as I have said before, if a metric has been of importance in the past, it makes it more likely to be of importance in the future. Because you asked so nicely, kindly analyze euro sterling. I absolutely will. I absolutely will. But I will say this: I've been chatting away now for the past 44 minutes. So I'll be looking to wrap things up after euro sterling. To be fair, now euro sterling as a currency pair, I haven't looked at a few days. We talked about how Eurodollar was recently hit a 1 month high, but that was mostly the weakness in the US dollar. So we'll see how euro sterling is doing. So euro sterling underwent a huge sell-off there not too long ago. It was only late June. Euro sterling was north of 0.87, and then only the last week or two, I was down towards 83.40 thereabouts. So it dropped about 300 pips in a matter of weeks. This is what I mean about how the bigger picture trend can paint the longer time frame can paint a very different picture. From what we have the peak here, with the lower low, the lower high, the lower low, the lower high, the lower low, the lower high. The question is now, though, this upward move that we're looking at here on the daily chart, is this just a rebound within the broader, much bigger, longer term downward trend, or is the market actually going to break above these moving averages? Is it going to break above these peaks here, and is it going to retest this area here up around kind of 85, 86? So this is what I mean about the 4-hour chart. Sorry, the 1-hour chart of euro sterling will show you one picture. Higher high, bit of a range, higher high, pull back, moving higher yet again. The 4-hour picture here shows you a fairly decent kind of upward move here, but the daily chart shows you we're actually still in the kind of much longer downward trend that's been in effect for the past 2 months. So looking at the 4-hour time frame, I'm a bit looking what's going on here. We've clawed back we've had a decent enough rebound. We're back above all 3 simple moving averages, not by a huge amount though. The highs that we've seen here haven't even gotten close to retesting the peaks of late June. We're kind of near the highs of late July, thereabouts, which is only about 2 weeks ago. So that isn't too convincing. Look at while we continue to hold above these 3 simple moving averages, it's likely to get the near term upward trend will continue. But I'm not overly optimistic because the rebound that we've seen in the grand scheme of things isn't too big, considering where we were in 1st of July versus down to, we dropped 340 pips in the space of 1 month. And in the last few days, we've only managed to kind of pull back of the 340 we've lost. We've only managed to pull back around 130. So we've pulled back only about a third or so thereabouts of the ground that we've lost. So that's not a particularly convincing rally. I'm gonna have to see how it goes. If it continues to hold above these two simple moving averages, it's likely to get the more medium term, the recent upward trend will continue. I'll be more confident if we get up towards kind of 85.20, and then the big level to watch out for will be this peak here in around 0.8580. And then of course if we clear that, then we can be looking at retesting the highs of early July. But I can't, between the kind of 4-hour time frame and the daily time frame, painting a picture on a big downtrend, I don't think we're going to be kind of shaking that. I can't really kind of ignore that fact. Let's draw a trend line in here. A pretty basic trend line. Just a trend line between the peaks of early July and on the peaks of late July. So while we continue to hold below this trend line, it's equally plausible that the kind of more medium-term downward trend will continue. Should we move lower from here on euro sterling, back down towards 0.84, and then the next big level to watch out for below that will be the recent lows of 0.8320. And then, of course, going below that, we'd be creating new multi-month lows, and then we'd be down towards 83, 82. I'll look to wrap things up there. So I do want to give a thanks for everyone who stayed on, who joined the webinar tonight, especially those who stayed on to the very end, and also a special thank you to the people who especially thank you to the people who asked a few questions. It's always nice to get a few questions because it keeps things interesting. We all have our own kind of habits and our own ruts, so that the certain currency pairs or markets or commodities we like to look at over and over again. So every now and again, it's nice to be kind of throwing a few curveballs like Aussie CAD, and I must take a look at Euro Sterling on a more regular basis. I got a comment here. Thank you for recommending the tech analysis book of the financial markets, by the way, the Bible of tech analysis. Yes, John J. Murphy, Tech Analysis of the Financial Markets is a very good book for those of you who are interested in trading and not necessarily have to become massive gurus within tech analysis. I would strongly recommend going out and buying the book and having a read of it, even if you don't take everything on board, because sometimes you look at certain things and you're going to go, I don't really believe that, or I'm not so sold on that idea. But it's one of those things. If you want to be in the markets and you want to trade the markets, a certain section of people that you trade the markets use charting, use tech analysis, and you at least have to be aware of what they're thinking. Not saying that you have to absolutely kind of subscribe to it, and I've taken the view now that text analysis is probably more important than fundamental analysis. But it took me a long time. It took me a long time to get there, and I spent too long dismissing text analysis. But at the very least, you should be aware of it, because even if even if you don't want necessarily going to fully commit to it, if it's a style of trading that other people are looking at, there'll be certain things going on in the markets that certain people will be aware of that you won't be. And let's face it, a bit of education never actually really kind of hurt anyone. So I would strongly recommend reading about tech analysis. Final question here: which two indicators is best for the market? The indicators that I use and I have on screen, the Maxi Indicator indicates momentum. Where is the momentum? Is it with the buyers or is it with the sellers? The Relative Strength Index, the RSI, is the market overstretched, or is the market neutral? Is it overstretched? Is it overbought? Is it oversold? Is it overstretched? I like looking at those, but to be fair, and not to sound like a smart aleck, but for me, price tells you almost everything you need to know about what's going on with the market. The actual price action, that's by far the most important indicator. And even people like Charles Dow and Co. will talk about that as well. And people who are really big into technical analysis will always talk about price action. Monitor, observe, study previous price action, study the various trends, and then try and use that as a predictor or as educated guess what you might think is going to happen in the next few minutes, hours, weeks, months, days, whatever time frame it is. So once again, I'll be thank you for everyone who stayed on to the very end. I just want to sign off now, and please feel free to tune in next Thursday. Thank you very much. Have a good evening, everyone. Bye now.